My name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible. So today I wanted to talk about a reminder as far as making the S corporation elections. What prompted this was I was reviewing a return that was done by another accountant, and this was a partnership that had elected to be taxed S corporation. And what raised some flags were that there were no salaries paid out to the officers. Actually, there were no salaries at all on the return. And it was a relatively new partnership, so there wasn't that much profit that was made because this is a relatively new venture. They are getting the legs beneath them, as they say, and they're ramping up. At the onset, there's not going to be that much. So it led me to question why the election was made. And I have a feeling why it was done, because one of the benefits of the S Corp is that you avoid the self-employment tax on your profits. So in this instance, the client was able to avoid the self-employment tax. However, in order to execute it properly, you have to have officer wages. You have to understand that if you're a partnership, you tell the IRS that you want to be treated as an S Corp, someone needs to be paid a salary for managing the company. Not necessarily all the partners need to get paid, but somebody needs to get paid or listed as a salary. Partnership, it's a little more lenient because you can decide not to pay anyone anything, and then you just divvy up the profits. And you just report the profits as need be. But once you make that conversion over to S Corp, someone has to be on payroll. And then another point that I wanted to mention, most partnerships have provisions for providing a distribution to cover taxes. So if you're in a partnership and there's taxable income, the company itself doesn't pay the taxable income. The individual's owners do. So the issue that gets created here is if the company doesn't actually distribute those funds, let's say those funds stay within the company, the partners are personally liable for their share of the profit. If we want to keep things simple, let's say that you had 4 partners and there was $100,000 in taxable income, but no one took money out of the company. So let's say that $100,000 was still sitting on the company's books. Now, each partner would then have to report $25,000 of income on the tax return and pay taxes personally on that $25,000, even though that money is sitting in the company. Obviously, that's not fair for an individual to pay taxes on money that they never saw. So in most partnership agreements, there are provisions such that a distribution has to be made to the partners so that they can pay their tax bill. I've seen provisions where you just assume that everyone's in the highest tax bracket, you make the distribution. So for example, let's say 32% is the highest bracket. You got to account for state too. If you're in a taxable state, let's say it's 10. The math, you have 42% on the profit. So if you made $100,000, 42%, partnership should then issue out $42,000 out of that 100 in proportion to the ownership. So if there's 4 partners, take the 42,000 divided by 4, each partner gets that, and then they're using that to pay the taxes. So you can do it that way. I've seen some instances where every partner would take their actual tax bracket. Every partner might not be in the same tax bracket, depending upon what every partner has other things going on. They may file with a spouse, they may have another business, they may have another job. So not every partner might be in the same tax bracket. So you could simply just calculate or figure out what bracket each partner is in, and then you can pay out accordingly based upon that bracket. There's a couple ways to handle it, but you just have to be aware that a distribution should be made for you to cover your taxes, because it can get ugly as the partnership becomes more successful, and then you start having to owe taxes on money that was never in your pocket. So just make sure that you have that provision in your partnership agreement. Most do. Just make sure it's being enforced so that you don't come out of pocket. So that's all for now. If you have any more questions about this particular topic or any other tax, accounting, business related topics, feel free to reach out. That's all for now. I'll talk to you in the next one.